All right, folks, welcome back. This is Interbank Price Delivery Algorithm, Section 2. We're going to be going over something that's pretty specific, and that is day range accumulations. Because for the ones that have learned this concept, I'm sure you've seen price accumulate for like 40 days or 20 days, and then it'll begin expanding. It'll just do very calculative stuff, in which I'm going to explain that in just a moment. It's very very simple. It's nothing too hard. This video is probably going to be like less than 12 minutes. I'm gonna call it right now 12 minutes while I'm recording it. It says 32 seconds, so we're gonna try to make it less than that just to make it easy for you. So let's go ahead and find current if to shift, which is well, we just shifted today, literally an hour ago, so it's really right here. But the previous one that we were just at is right around there. And if we draw our days out, that's 20 day. That is closest as we can get to, and then that's 60 day, and then this should be 21. Yes, close enough. All right, now looking forward, right? This is casting forward. Okay, when you're casting forward, this is where this mainly applies to because you're casting forward because you're actually seeing what price is doing, casting forward. Duh, right? So look, pay attention here. We're gonna mark the 40-day range, which is about right there. Now watch this. It's gonna be pretty interesting. You notice that during the first 40 days, which is in between these ranges right here, I'm gonna try to get the lines in on top too. In between that range, price is doing what? Obviously accumulating, right? Obviously. Now, right outside of the 40-day range, or when the 40-day range ends, what does it begin doing? As you can see, that the candles start to get bigger and they start to get a little kind of sort of a little smoother, in which they start displacing. Now, this is not random. This is not random. Now, currently, I don't know how to anticipate this. I really don't. You're just gonna have to like experience it yourself and actually like realize that price might be accumulating for the first 40 days, in which 40 days is a pretty long time. I'm not gonna lie, that's basically 2 trading months. So you're actually gonna have to go through this annoying price action and literally just wait it out. What you can do is, if you know that price has been accumulating for more than 10 days, like not necessarily like accumulating every single day, like just straight consolidation, but on the daily, you can clearly see that it's forming a consolidation for more than like 10, 15 days. Then wait for each day range to end and see what price could possibly do based off of the current confluences that you see. Like, for example, if you're right around here and this is like the 15th day before the 20-day range ends, go ahead and have the 20-day range marked as a vertical line to see what price is going to do after that range. Okay. And it's pretty cool because power of 3 can actually be applied. Listen to me. It can actually be applied to these ranges. It's very, very minuscule. But watch this. You can see that the first 20 days kind of go back and forth. We got up, down, up, down, up, down, up, down. You get it. Back and forth consolidation, right? Moving over to the 40-day, this range here. After the 20-day range ends, it actually jumps up, manipulates into this high as a buy side liquidity purge, hits this propulsion block, and then accumulates some more. So overall, what's happening here is the first 40 days is accumulating and manipulating at the same exact time. Not exactly on like a power of 3 type thing where it accumulates, jumps up, then goes higher. Not exactly like that, but it'll be doing that while it's accumulating. It's going to take a little bit of experience and just time in the charts to be able to see it. But once you know how to do, well, I just, kind of started there, but once you know how to put together your confluences and actually understand them, then finding that is very, very easy, like effortless. It's very, very easy. So now that you understand that there's a thing such as day range accumulations, let's go over this here. This was very, very interesting. This is very, very what's the word? If I can even get it. Where was the day range at? I mean not day range, but the shift. I think it was December. Yeah, December 1st, I think. Because hold on, if I marked it here and I do this, it should be 60 days. Yep, it is 60 days apart. Okay, nice. You delete that. Now, I should have copied those drawings, but it's okay. Here is 20 days right there. Here is 40 days right there. Want to get as close as you can to it. And here is 60 days right there. Then if I can I move this up? Hello? Wait, hold on. Oh, okay. See, now it wants to change charts. All right, buddy. Hold on. I'm just trying to move this up for you. Oh, okay. There we go. Now, looking here, it's basically the same exact example here. It accumulates during the first 2 months or basically 40 days of the IPDA data range or the current what's the word? IPDA shift, in which if you look here, up, down, up, down, up, down. I don't have to explain. You get the point. But while it's doing this, what is it doing? It's not necessarily manipulating, in which it's not doing that here, but it's engineering liquidity. There's a lot of things that's going on here. So whenever you see a day range accumulation, just know that it's not just accumulating. Okay, obviously accumulations mean higher volatility and more aggression, but it's doing something specific in which it is what? Purging buy side and accumulating sell side. So what's going to happen when this 40-day range ends? What do you think is going to happen? It's obviously going to expand, in which, guess what? 40-day range ends, drops down, engineers more sell side liquidity. Okay, listen to me here. Drops down, accumulates more sell side liquidity, rises back up, purges this buy side right here, which is an intermediate term swing. You got the short term, then intermediate in the middle. So it purges that swing, bang, right there. Then it reaches up to all time high to engineer more equal highs for the future, like way, way, way in the future, like maybe the end of 2026 type future. But it does reach up there, fails to displace through it, and it starts dropping, 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 dropping. So this was basically a this entire IPTA shift right here, the December 1st IPTA shift 2025, was basically an entire accumulation and manipulation for this IPTA shift on February 1st, 2026. If you really look at it like that, that's basically what it is. Like if I let me see. That's exactly what it is. That's pretty funny. Let me see if I can actually do it. Why is it not copying it? It's like you can highlight over them all and it'll copy all of them. That's weird. It's not doing it. Hold on. Okay, yeah, whatever. But oh, there we go. Now I can copy this, boom, and drag this over to February 1st or around there. And you can kind of sort of see what I'm talking about. Like if you want to pause the video and see, you start to notice that this was actually an accumulation and accumulation, manipulation, distribution, or power of three type scenario. But it just did it very precisely and calculatively through if the data ranges or day range accumulations. I could just end this video here, like right on the 8-minute mark. I did say it was going to be less than 12 minutes, but I didn't think I was going to be done this quickly. Um, yeah, this is really it. Honestly, there's really not to talk about. Not a lot to talk about when it comes to day range accumulations. Well, I guess I'm ending it here. This is the end of interbank price delivery algorithm, section 2. We went over day range accumulations, a very, very simple but needed to be known detail, very, very critical detail, in which I hope I taught it to you well, and this should be insightful to your long term analysis. Until then, I'll see you in the next one. Good luck and good trading.